$4.4 billion, gone in 13 days. That's how much money just fled from U.S. spot Bitcoin ETFs, the largest outflow streak since these funds launched in January 2024. And the institutions leading the exit include some of the biggest names on Wall Street: BlackRock, Fidelity, and Grayscale. In the next 10 minutes, I'm going to break down exactly what happened, why the smart money is running from Bitcoin right now, and what this record exodus means for crypto prices, the stock market, and your portfolio, whether you own Bitcoin or not. Because this isn't just a crypto story. It's a story about interest rates, risk appetite, and what happens when the Federal Reserve changes everything. Let's start with the numbers. From late May through early June 2026, U.S. spot Bitcoin ETFs suffered 13 consecutive days of net outflows, the longest losing streak in their history. Total money pulled out, $4.33 billion. That's roughly 59,400 Bitcoin sold, converted back to cash, and removed from these funds. In a single week alone, the outflows hit $3.4 billion, a record for any one-week period since these ETFs were approved. BlackRock's iShares Bitcoin Trust, ticker IBIT, was hit hardest. The fund that was supposed to be the flagship of institutional Bitcoin adoption saw $980 million in outflows in just 1 week, its worst week ever. Fidelity and Grayscale followed with significant redemptions of their own. So what happened? 3 things hit at the same time, and when they all land together, institutional investors run. First, the Federal Reserve. New Fed Chair Kevin Warsh has made it clear that rate cuts are off the table. At the June meeting, the Fed held rates steady at 3.5 to 3.75% for the 4th consecutive meeting. 9 of 18 Fed policymakers now see at least one rate hike before the end of 2026. When interest rates go up, or even when markets expect rates to go up, risk assets get sold. And Bitcoin is the ultimate risk asset. When you can earn 4% in a treasury bond with zero risk, the case for holding volatile crypto becomes much harder. Second, 2-year treasury yields hit their highest level since early 2025 this week, rising above 4.22%. That's a direct competitor to Bitcoin. High-yield cash equivalents pull money out of speculative assets. Third, profit-taking. Bitcoin had a massive rally in 2025, hitting all-time highs above $100,000. Many institutional investors who bought in early sat on huge gains. When the macro environment turns unfavorable, they book those profits. Selling begets selling. The result: Bitcoin fell more than 10% during the outflow period. Now, here's what's important to understand about Bitcoin ETF outflows. These are not retail investors panic selling. These are institutions, hedge funds, family offices, portfolio managers, making calculated decisions about risk allocation. When they pull money from Bitcoin ETFs in size, it's a signal about the broader risk environment. And right now the signal is reduce risk. The irony is that the Bitcoin ETFs were supposed to usher in a new era of institutional adoption. And they did. In 2024 and early 2025, billions flowed in, pushing Bitcoin to new records. But institutions are not buy-and-hold investors like retail. They rotate. They hedge. They exit when the math stops working. At 4% treasury yields and growing rate hike expectations, the math for Bitcoin is getting harder. What does this mean for you? If you own Bitcoin directly or through ETFs, understand this. The institutional tide has turned short-term. That doesn't mean Bitcoin is dead. It means the macro headwinds are real, and the easy money era that drove crypto's last bull run is over. If you don't own crypto, this matters because the same forces, rising rates, tighter financial conditions, are putting pressure on all risk assets, growth stocks, speculative tech, small caps. The market is repricing for a higher for longer rate environment. Goldman Sachs analysts noted this week that the correlation between Bitcoin and the Nasdaq has increased significantly during the outflow period. When Bitcoin sells off hard, tech often follows. And when the Nasdaq gets hit, the S&P 500 feels it too. What should you watch in the days ahead? The PCE inflation report this Thursday is the single most important number. If inflation comes in hotter than expected, rate hike expectations will intensify, and risk assets, including Bitcoin, will face more pressure. If inflation surprises to the downside, some of this pressure could ease. Money could flow back into ETFs, Bitcoin could stabilize, and the narrative could shift. But right now, $4.4 billion is telling you which way the smart money is leaning. Subscribe for daily coverage of the market moves that affect your money. We post every single day, so you're always a step ahead. I'll see you in the next one.